Hey, hi, good week to all. Welcome to this week latest edition of the weekly technical outlook on the major stock indices for the week of 29th of November to 3rd of December. So we're now coming very close towards the end of the year, so it's about less than 25 days more before we actually bid goodbye to 2021. So as usual, we'll be covering the latest trend buyers in terms of the multi-week trend buyers or quite the medium-term trend buyers for the SPX 500, the Nasdaq 100, the Hong Kong 50, the Japan 225, and the German 40. And especially, I believe that most of you are pretty much interested or anxious to know what happened next after we start to see a kind of a new COVID variants, new COVID variant scare that happened on last Friday. So before we start, let's take a look at the disclaimer slides first. All right. So as you all know that last Friday we start to see a domino effect, an adverse one that actually took down almost the entire spectrum of the global equity space. That includes other risk-on assets such as the dollar yen, the oil, as well as various commodity currencies, various cryptocurrency. So if you look at across the board, we start to see negative return, right? In fact, negative return. The one that's kind of performed the best in terms of a sea of red is still the US stock indices, all right? So we could see across the board is negative. So like we highlighted earlier on, is actually attributed by this new COVID-19 variants, get quite the Omicron, my me. Okay, so later I'll share with you all what my view on Omicron. Actually, I do tweet it over at my Twitter handle. In fact, yes, on the weekend as well as today. All right, later I'll highlight you all to share with you all how to actually get what I call a fast moving commentary on the markets. All right, so right now it's purely on the technical chart. Okay, so as you all could see that a sea of red, right? The one that is kind of hardest hit will definitely be Europe itself. Why? Because you know that Europe itself, number one, prior to the new COVID-19 variant, there is actually a rise in COVID-19 cases in Europe. So that kind of further add on to the further damage on the European stock indices, where the DAX actually declined by close to this negative 5.6%. So all in all, right, is momentum wise it's kind of negative if you look at it across the board. If you look at the difference as well. Okay, so right now, right, let's go to take a look at the sectors. So the various breakdown of the sectors also a sea of red. So we have not been seeing this for quite a while, since about a year, almost a year. All right, where we start to see a sea of red across the 11 main sectors in the S&P 500. So as we highlighted earlier, most of the losses was inflicted on last Friday. And also, what causes these losses to be so drastic is number one, on Thursday and Friday, we call it the Thanksgiving holiday. Especially Thursday, the US market is closed, where there is lesser liquidity in the order books. And as well on Friday, it's a short-term trading session. So that could potentially be a what I call a thin trading environment across the globe with the closure of the US financial markets. Uh, Not 100% closure, I would say it's about 80% closure, taking into a consideration of the Thursday holiday, Thanksgiving holiday. So that could actually exacerbate what I call stop loss levels could be triggered pretty much easily and create this kind of negative domino effect across the spectrum. Okay, so now most importantly is what's going to happen next potentially, right? For traders, I mean, we want to know going forward what is the next step, what are the key levels to watch. Okay, so let's take it one step at a time first. Okay, so let's go down to the indices. And also, I'd like to highlight before we jump into the S&P 100, I'll tend to usually given such adverse or drastic movement across the board in all the major indices that we see across the globe and actually impact the rest of the other asset class as well, like dollar yen or oil. So I'll tend to look at one particular leading sector of the US stock market, which is the general, that give us a clue what is going on. Because once a leading market starts to show further signs of weakness, the rest will actually should follow suit. It's only depending on the degree of weakness that being inflicted on the respective indices. So the one that is leading the default in terms of the US um, market will be the semiconductor sector, or the SOX, okay, SOXX in short. So you recall the SOX, right? We previously have a target or a key resistance that we highlighted about 3 months ago at 556.70. And last week, before prior to the I mean the Friday sell off, it actually hit, almost hit on, okay, let me highlight to you, on Monday, which is a high of 548.15, give or take, it's almost there. And what's interesting over here is that the sell off itself on Friday was not so drastic as compared to the rest. Okay, so if I were to open the, let me show you all the, okay, so you could see on Friday, right, it actually tumbled only negative 1%, 1.10%, versus you start to see in close to about 2% that you see on the S&P 500. So we're talking about this is a market leader. Yeah, even though it actually what you call it, shape a lesser magnitude of decline. Let me remove all the floating box, okay? But however, the technical picture, right, in terms of momentum wise, based on as measured by the daily RSI, you see you start to shape a bearish divergence or negative divergence, where we start to see prices do a higher high, but the RSI start to shape a negative divergence. And what's important is that this negative divergence actually form right at the extreme overbought level, which is at this level here. All right, 81%. Okay, so divergence, negative divergence or bearish divergence forming at a extreme overbought level, it's not a good sign. That means it's telling us that the outside momentum has started to slow down. This is medium-term outside momentum, not hourly momentum or not 4 hourly momentum. That's short-term momentum. So, given the what I call it, a slowdown in outside momentum from a medium-term perspective, we could expect a multi-week corrective pullback to actually occur potentially in terms of probability. So I'll be watching the first support definitely at 47 6.45, 476.45. And by the time if the price will actually hit to this level, your RSI should actually start to work up from this extreme work up from this extreme overbought level and float back down to a key support zone over here. So if we were to look at this situation, potentially, right, we could see another decline, about close to 8% more, okay, before the market actually calms down and resume its, what I call it, major uptrend phase that's still in place since the low of 18th of March. All right. So now, so with that in mind, right, with the SOX or the semiconductor index showing this particular signs of, what you call it, exhaustion in terms of momentum, we could actually attribute that the S&P 500, the Nasdaq, and even the Dow and the Russell could have more potential downside to actually take shape beyond the level that was seen. I mean, beyond the low that was seen on last Friday. But as you all know, that markets don't go vertical all the way. I mean, it's not a vertical waterfall. So there will be what I call short-term corrective rebound. So later I'll share with you what's this short-term corrective rebound about. So let's take a look at the chart of the S&P first. And why do I also say that potentially there is still more rooms to actually fall before we start to see some kind of stabilization? Okay, take a look at the chart of S&P. If you look at the RSI, very similar as well. The RSI also shaped this bearish divergence. All right, that was formed. Okay, after hitting the all-time high at 4,743 on 22nd of November, which is on Monday as well. Then thereafter, the RSI starts to break down and still has a bit of room more to go before coming to hit a significant corresponding support at the 41% level. And also that could actually correspond with the 4540 level and 44 level zone, this zone over here, which is the 50-day MA and the 200-day MA. All right. So what it means over here is that in terms of the Elliott wave as well, what we could potentially see is the end of that medium-term wave tree, impulsive wave structure wave tree. That means indicating to us that the medium term, we call it trend from the low of this wave two, which is 24th of September, has more or less ended. So right now, what we are seeing now is a multi-week corrective wave four that could potentially take us down towards this zone over here. All right, before the price action continues to do that wave 5. So this wave 5, right, could potentially be the last wave of this major uptrend that takes shape from the low of 23rd of March 2020, and also could be the last circular top of that Romanic Roman wave 5 the V, that could actually end the entire 13-year, or next year will be 13 the 13-year of uptrend that started in March 2009. Okay, that we got to observe one step at a time. Okay, so we take it from a breakdown from a weekly perspective yet. All right, weekly perspective basis. So for those who wants to find out more about my long-term outlook, do keep a lookout because I'll be publishing the year ahead outlook pretty soon. All right, or from the research team in APEC, from CMC APEC research team. So what's the strategy for this week? Okay, so like I said earlier on, there will be no there will be no stretch waterfall decline. So what we could see now is a mean reversion corrective rebound. Why there's a mean reversion? Because if you look at the 4-hour RSI, this is 4-hour RSI, not daily RSI. The 4-hour RSI has started to shape a bounce up from the oversold region and has still a bit of room more to push up to hit this descending resistance, which is considered as a significant corresponding resistance at the 61% level. And also, if I were to draw the Fibo retracement of this last leg steep slide down that was seen on last Friday, taking from the high of 22nd of November, the 61% or 8% is close to this intermediate resistance at 4,700 level. So potentially, right now, what we see over here is a workout of this current short-term extreme downside movement. Because as you all know that like I said earlier, price action don't go all the way down. There will be what we call property of mean reversion in the short term. So right now we are seeing this potential mean reversion short-term rebound to actually take shape. How long could it last? I would not know how long could it last. Perhaps maybe 1 or 2 days. But the key levels to watch will be 4,700 and 4,745. So this is the region that especially the medium-term pivotal support, which I set up, is 47.45. Then as long as this 47.45 is not cleared, that means there's no bullish breakout above it. After this mean reversion rebound ended, we could see another leg down potentially to test the next support at 45.40. So recap, what is 45.40? If you go back, 45.40 is the former swing high area of 3rd of September, and as well as the 50-day moving average. Okay, we have a confluence of we call elements that is actually coming to make this 45.40 a significant level. And most recently, if I were to actually take the Fibo retracement of this last leg up, 1st October to the 47.45 level, it's close to 38.2%. Okay, retracement. All right. Okay, so we are still expecting a further potential push down after this short-term mean reversion rebound is actually over. Okay, so but definitely if we start to see a 4-hour close above 47.45, then we could actually see what you call it, a further move. That means this corrective wave 4 corrective uh, sequence is invalidated for us to push up much higher to the next resistance level at 48.70 slash 49 figure level. Okay, so now where do we go next? Will be the Nasdaq 100. So if you look at the Nasdaq 100 over here, okay, so Nasdaq 100 very similar as well. The bracket 3, medium term wave 3 impulsive wave structure is more or less ended at this 16,770 level with a couple of Fibo expansion clustering at this level. So what it means that, i.e., right now we are in the process of a multi-week corrective wave 4 to actually retrace a portion of this wave 3 bracket wave 3 that has ended. That means taking from the low of 21st of September all the way up to the high of 22nd of November. All right, so that will be the wave 4. So after this wave 4 ended over here, okay, so the wave 4, how low will it end? I got to take it one step at a time. The first support to watch will be at 15,700. If it break below, then it will be beside in this zone over here with a maximum downside limit at 14,480 slash 14,320, which is also the 200-day moving average. And if I were to draw a Fibo retracement, which is the minimum of a bracket wave 4, it could be around the 23.6% level, slightly below 15,700, which is inside this zone over here, and also the 38.2%. Okay, So this is the two levels to actually watch to see potentially this wave, how low this wave four bracket wave four will go before we start to see the final bracket wave five to complete potentially this major uptrend phase that is in place, still in place from the low of 23rd of March 2020. Okay, let me remove off the Fibo retracement. Okay, so the strategy for this week is similar as well. After the breakdown of last Friday price action, so what we could see now is the RSI is now trying to bounce up from the oversold region. So potentially we could, similar like S&P, we could see a short-term mean reversion rebound towards 16,460. Then thereafter another potential of down leg to take us much lower towards 15,700 slash 15,520, which is the swing high area of 6th of September, as well as this 50-day moving average as well. Okay, towards this region here. So as well as the lower boundary of the short-term ascending channel. Okay, so as long as 16,770 key medium-term pivotal resistance doesn't break up to the upside. Okay, so if we start to see a 4-hour close above it, then we could more or less say that this corrective decline scenario has been invalidated. This is where we start to see a continuation of this impulsive wave structure towards the next resistance at 17,170 slash 17,230. Okay, now the next one will be the Hong Kong 50 or the Hang Seng Index that is still being kind of a clouded recently by this ongoing regulatory clampdown. And today there's another negative news surrounding about the Hong Kong Macau casino operator. There was a kind of a arrest of one of the key players inside this Macau casino industry. So that lead to be a fear of what we call there may be further what we call regulatory clampdown within the Greater China region. That means that consists of Hong Kong, China, private sector, and as well as spread because Macau there's actually a couple of stocks, Hong Kong stocks that's listed in a couple of Macau stocks, Macau casino stocks listed in the Hong Kong exchange. So that could actually be potentially be driving this ongoing weak sentiment. And don't forget, on top of that, we have this new COVID-19 variant, the Omicron, that is still causing a bit of uncertainty in the financial markets. So what we have over here is that last week we have a key medium-term pivotal support at 24,550, where this is a level for us to watch to play that short-term that bounce within this big complex sideways range that is in place since 5th of October lower. But however, it just pierced through on last Friday, which invalidated our bullish sideways scenario. So what we see over here right now is pretty mixed. There's no clear signs of a reversal. Yes, RSI is oversold, but I'm not so convinced to actually play a bounce back towards 25,820. So it's still hovering above the long-term key pivotal support at 24,000 slash a bit of excess at 23,500. So what's this level? Go to the weekly chart. This level is pretty key. It's actually the long-term circular ascending support that managed to cap previous steep decline, okay, from Jan 2018 to March 2020. So that was actually during the trade war as well as the Hong Kong internal protests. And during this period is the yuan, the Chinese yuan shock devaluation. And most importantly, this was the great financial crisis low. Okay, so definitely this is a key level to actually to watch. Okay, a weekly close below this level definitely is kind of game over, where we could start to see a more pronounced decline to actually test the March low at 21,480, the March 2020 low, and even later much lower. Okay, over here at 18,500 level. Now, so for this week, right, I will keep a neutral stance, neutral between 24,550 and definitely the long-term key pivotal support over here. And unless we have a 4-hour close above 24,550, that means a reintegration back above last week medium-term pivotal support, then we could be more in terms of probability, the probability will increase to actually see at least a bounce back towards this 25,820, which is this also the descending trend line resistance in place since 11th of August that has kept previous two rebound of 8th of September, 25th of October, and with the third rebound very closely at 16th of November. Okay, so now coming to as a resistance at 25,820. So if we have a weekly close below 23,500 level, then I would say that we're going to be very, very careful on the Hong Kong stock market, where we could start to see a series of potential multi-month decline to actually see further downside. Okay, so the first support level after 23,500 breaks will be 22,100. Right. Now, the next Asia indices that I'd like to cover will be the Nikkei 225 or the Japan 225. So the Japan 225, last week, similar as well, it actually broke down the key medium-term pivotal support level, which is at 29,070. So initially, we are actually looking to play this push-up back towards the 30-year high level or the as well as the range top since in place since 16th of Feb 2021, which is at 30,716. So now what we're seeing now is potentially it could go back to retest this key medium-term range bottom or range support at 27,500 level slash 26,880 level. So what we could see is the RSI over here is pretty much muted as well. Nothing really that fantastic, still kind of hovering above the oversold level. Okay, so now let's go to the 4-hour chart. Okay, the 4-hour chart over here. So you could see the 4-hour chart. What's so interesting about this 4-hour chart is in terms of the fractal geometry. So where this current rebound ended, it actually ended at 29,970. So what's interesting is this 29,970 is being defined by the Fibo projection, taking from the low of 6th of October towards the high of 20th of October. Project it down from the 25th of October is 61.8. Okay, and if I were to do a retracement, taking from the previous low over the previous high of 14th of September all the way down towards the low of 6th of October. Okay, let me change a different color. So you could see it's actually stopped at around the 76.4% as well. Another confluence level of Fibo retracement and Fibo projection. And what we could see over here, oops, right now, if I were to do a Fibo projection, taking from the top of 14th of September to the low of 6th of October, project it to the 16th of November high, you could see 0.618 is at 26,000, 27,650 slash 500. This level confluence graphically with the key medium term range support level or range bottom, which we highlighted earlier over here. 27,500, lower boundary is 26,880. So this could be an interesting level or a magnet for the price to actually retest or come back down again. All right. And if I were to do a retracement from the low of 6th of October towards the 16th of November high, you could see over here again. Okay, sorry about that, it's a bit sticky. Also at the 76.4% retracement, similar to what I drew from the top of 14th of September to 6th of October. So what you could see is the what you call it a interesting observation on Fibo geometry, that this level here seems to be a potential magnetic level for the price action to shape further potential downside before it starts to actually recover again. So all in all, what it means, the price movement of 14th of Sep so far to 16th of November is still range bound. It's still consulting a range, and potentially it could be a symmetrical triangle as well. Okay, so all in all, right, for this week's strategy is we are flipping to a bearish stance on the Nikkei 225. Not a very extreme bearish stance, that's to say that it will take down below 27,650. Maximum it will go down is we will actually look to actually for this downside to hit this level before consolidating again. So it's a more like a bearish bias within a range configuration, and it could be a potential symmetrical range configuration that I explained earlier on due to the Fibo geometry that I draw earlier on the confluencing. Okay, the confluencing element. So right now we may see a potential a bit of bounce up because of the RSI hitting at the extreme oversold level. Yeah, right at the 4-hour RSI hitting the extreme oversold level, a bit of room more to go before hitting a key corresponding resistance around the 56% level. Okay, so that should actually correspond to the intermediate resistance in price level at 29,340. So I'll be using the high of 16 November as my key medium-term pivotal resistance, 29,970, to actually have this bearish view within is a potential symmetrical triangle range configuration, where the next step is for it to actually shape a potential push down to test the lower boundary of this range at 27,650 slash 27,500. So nevertheless, a 4-hour close above it will actually invalidate this bearish scenario within its range to see a push up towards the top of the range, the top of the medium term range, which is at 30,716, 30,870. All right. Now the last one will be the German 40 index, okay, or the DAX. All right. So if you look at the DAX over here is yeah, we could actually see last week's slide was kind of pretty drastic as well. Okay, a single day slide. Okay, so we have not seen such a decline within this medium term uptrend from 20th of Sep, 25th of Sep, as well as the major uptrend from March 2020 in terms of single day decline. We have not seen such a huge candle before. So what we could see now is a bit of mixed element. So price action now, it seems to be attempting to actually kind of a recapture or recover the 200-day moving average. So last Friday, price actually broke down the 200-day moving average. Okay, so this is the first time a daily close below the 200-day moving average since this major uptrend that is still is in play since 19th of March 2020 low. So, but if you look at it, the RSI also tried to bounce off from a key corresponding support level at the 20% level that was actually formed upon the major, we call it major uptrend low of 19th of March. Okay, so what we could see is a bit of mixed element. So this could be a recovery. Okay, but in terms of price action wise, if you look at the 4-hour price action, it's still a bit not so convincing. In terms of the potential recovery. So what we could see over here is there's no bullish divergence. Okay, so what I mean by bullish divergence? If you look at this previous recovery from this previous fall of 13th of August to 6th of October 2021 low, before the price shape another impulsive up move up to shape higher high and all-time high, the RSI actually shaped a bullish divergence first. Okay, what am I bullish divergence? Lower low on the price action, but higher low on the RSI and at the extreme oversold level. So what we are seeing right now is, yes, the RSI hit the extreme oversold level, but there's no bullish divergence that occurred in the past that lead to a new impulsive up move structure. Okay, so all in all, what you mean over here is that yes, it's go to the extreme oversold, but to see it shaping a new recovery or the start of a new potential impulsive wave structure to take it to higher high, that means going breaking above 16,300, the odds of this happening right now is relatively low. Why? Because there's no bullish divergence. So what we could see potentially could happen over here is just a short-term mean variation rebound, maximum up towards 15,800. So that was last week key medium-term pivotal support that was taken out pretty swiftly on Friday. So given the kind of mixed element that we see so far, right, I would actually prefer to have a neutral stance between 15,800 and 14,750. So unless we have a 4-hour close above 15,800, then we could actually validate a bounce at least up towards the current all-time high level at 16,300. All right. So if we have a 4-hour close below 14,750, then we could see a further waterfall slide or slide towards the next support level at 14,330 in the first step for the German 40 index. So all in all, right, we could actually start to see over here potentially uh, right now we're actually shaping this kind of multi-week, we call it pretty much choppy, I would say corrective decline first in first step before a bit of stabilization to take shape in the market before the market could actually start to digest the new COVID-19 variant news flow. Then thereafter we could actually start to see we call it a new we call it impulsive wave structure to take up potentially to higher highs. And one of the points that I want to highlight over here is if this COVID-19 new variant is seems to be rather we call it more transmissible in terms of the current vaccine may not be as good as offer the same protection as the Delta variant. So it means that potentially it could create more economic restriction in terms of lockdown and travel restriction among international countries. So all in all, that could actually dampen the pace of Fed hawkish guidance. That means, i.e., they could either reduce the pace of their tapering. They will still taper, but they reduce the pace of their tapering in the next December meeting, and that could actually means that the first rate hike will be pushed back. Because right now market is pricing for the first rate hike to actually come in the first part of the year, which is June. So that could be actually pushed back to around September or third quarter of next year. So that could be actually be positive for the stock market, at least for from a 1 to 3 months perspective before they complete that romantic circular wave 5 target. All right. So, like I said earlier on, how do you keep up to date with daily commentary on the market? You can actually follow me at Kelvin SC Wong. So that's my Twitter handle. Okay. Branded by CMC, definitely. So at Kelvin SC Wong, you should follow me. Then after that, you on the notification, you're able to see my daily tweets. So this is my this is my chart of the week, which is Dow Jones. So what I'm expecting is a potential short-term bounce before another potential decline. So this I already highlighted earlier. Very similar structure on the S&P 500 and the Nasdaq 100. Okay, so then this will be my something of my daily tweet that I do every morning before 10 a.m. All right, before 10 a.m. So I will start the day highlighting to you all what are the key events to watch. All right, over here. So do give a follow at my tweet to actually keep updated to actually what's going on in the financial markets globally. So with that, have a great trading week ahead. Great trading week ahead, and I see you in my next video.